This video is all about how to know when the housing market bottom is in. Today, I found a news article published by CNBC that I found to be quite intriguing. I found it to be kind of tone deaf to what's actually happening in the housing market. But I wanted to share it with you because I want you to have the most actionable information so that you can make the best decisions for yourself, for your family, and for your financial bottom line. If you're new to the channel, welcome aboard. My name is Chris Igoe. If you're a returning viewer, I appreciate your participation in our journey. If you find this content valuable, please subscribe to the channel and let's get into it right now. Now, keep in mind, this narrative is not necessarily something that I subscribe to, but I think it's very important to talk about it because there is going to be a ton of information over the course of the next year that will confuse you. And so my job is to provide commentary as to what I see in real time and as I experience as a boots on the ground operator of a high performance real estate team. So if you're thinking about moving, please reach out. We would love to help. But today, published on CNBC, the bottom line, and I'll include this link in the ad copy down below. But the title of this is In This Volatile Housing Market, Here's How to Know When the Bottom is In. And here are the key points. Forecasts for home prices declining this year are moderating. Zillow now expects a slight increase. Well, that's interesting. Are they expecting a slight increase in price declines or are they expecting slight appreciation? Yet to be determined. I don't know. My bias would tell me that they're expecting a slight price increase. And that is exactly what we're seeing right now in my local market. And I'm aware that this is not every market. Each market is going to trade differently. But right now in my market, that's what we are experiencing. Now, it will be very interesting to see how this plays out over time as the pain of recession worsens. And yet to be determined, I don't know. But if you watched my last video, which I will link at the back of this one, you'll know that we're starting to see corporate defaults. We're starting to see the commercial mortgage-backed securities market get decimated. And we're starting to see the pain of recession impact some of these big institutional monies, some of these big institutional commercial backed securities firms. And it's going to be a nightmare. It's going to be a big story in 2023. It goes on to say in the key points that inventories are climbing, but below pre-COVID levels and existing home sales are stabilizing. The biggest housing market declines have occurred in cities that soared in 2021. Well, that's not true in my market. And we've had a tremendous run in my market, but we haven't seen declines in my market at all. We have absolutely seen pie in the sky expectations of sellers get decimated. But in terms of growth, in terms of price cuts or value cuts, I should say, but if the home is priced the right way and it is the right product in the right place, it will sell very quickly. Finally, the last key point is that unlike 2008, people have more savings and jobs and less onerous mortgage loans, with 85% of homeowners under a 5% rate. Well, I take some umbrage with that statement. The consumer today does not have more savings than they did in 2008. In fact, the consumer right now and the typical American has less savings than they ever had at any other point in history. And the unemployment number that's being discussed in the media is not representative of what the actual unemployment rate is because they are going off data based on a flawed survey. So I do not agree that people have more savings and more jobs across the board, but there are different buyers in each market, and some are going to be squeezed differently than others. But by and large, the consumer is in much worse shape today than in 2008. Now, I do agree that most homeowners do have a tremendous amount of equity. And I do agree that 85% of homeowners are under a 5% rate, which is also why we're seeing a scarcity of listings hit the market, because most of these people who are in at 5% have no intention of taking on a 6.5%, 7%, 8%, 9%, 10% loan. They're just not going to do it. So it has to make economic sense. Now, what I will say is, as the weakness in the market continues, as supply increases, as demand changes, well, you are in a position to be able to leverage that weakness in order to get a better rate than what is publicly advertised. So I can build an argument that now is a very good time for move up buyers if we get the right deal, but that's going to be on a case by case basis and totally contingent on supply and demand and the strength of the market. But let's go on to what the article says. And according to Jeremy Fisher, who is a Chicago realtor who headed to Florida after Christmas, counting on 5 mostly relaxed week, after a slow second half of 2022 left him with a bunch of unsold listings exiting the year. Instead, the Compass broker ended up flying back to the Windy City 3 times during his low season, as 7 homes went into contract and his husband ended up driving their baby home from Florida alone. The great real estate bust, it seems, has found something like a floor. Well, let's be totally clear here. There has been no great real estate bust yet. So, if that is what you believe, that we've gone into a real estate bust, that is certainly not what has happened in my market. Other markets have felt different pain. Other markets have different intensity of demand. But in my market here in South Florida, there has been no great real estate bust unless you've overpriced your home and you're not actually interested in selling your home. You're more interested in hitting the lottery. Well, the lottery days are over. It's back to reality. And to be clear, that's not a great real estate bust. That's a return to normal. Now, this next quote I love because I say a different version of this all the time. For somebody, it's always the right time to buy a house. And I'll say it differently. The market is always good for someone. And so, what I do believe is different than 2008 is as we get into distress sales, as we get into foreclosures, as we get into a real shift in the market, not what we've seen, which is a return to normal, but as we go back to what feels like a crash, there is always someone out there that is interested in buying a home. And that's someone these days, or that's someone in the future when the market really does implode, is going to be institutional buyers, which did not exist back then. So if there is a mass bust of the housing market, there are hedge funds, institutions, all types of big money that is prepared to scoop that up with 2 fists. So I don't know that we'll ever even get access to that inventory. It may just be packaged up and sold to the highest bidder. Yet to be determined, I don't know, but that's what I suspect will happen. Now, it goes on to say in this article that Goldman Sachs trimmed its estimate of peak to trough declines in nationwide home prices to 6% from 10% in late January. Online housing marketplace Zillow now expect prices to rise slightly in 2023. Existing home sales, which were running at 6.5 million annual pace in early 2021, have begun to stabilize around 4 million, according to the NAR, which is the National Association of Realtors, forecasting 4.8 million for the year. Meanwhile, mortgage rates, which have been escalating quickly, have dipped a little bit to under 6% national average on February 2nd. Well, that's all well and good, but when the most recent inflation numbers came out, they jumped. They jumped back to 6.75%. And you can expect to see more interest rate hikes. You can expect to see more mortgage rate difficulty. There is an affordability issue, and the Fed is beholden to stamping out inflation. So the fact that there was a scorching January jobs report is no bueno if you're looking to get a mortgage in the future. And there's no bust, but a standoff between buyers and sellers. Well, that is absolutely true. And that's exactly what we're seeing in my local housing market. And unfortunately, I think sellers who have motivation to sell, but pie high expectations, they are going to feel the pain of losing equity because, or the perception of equity, because the truth is, we found properties in my local market within the last week that were originally listed at 2.75, and we got those homes under contract at a 40% discount to original list. So if the belief is pie high expectations, well, that's not going to bode well in the future for those sellers because the buyers have all the leverage. And so what we've got here is, on one hand, you've got buyers who would like to purchase homes back at 2019 prices. and sellers who are under no pressure to move since they've got cheap mortgages and plenty of equity for now. Which is why it is critical, if you're thinking about selling, to get in front of this next phase of development of the market. You definitely want to be in front of the other competition that's also thinking about selling, because as the pain of recession and economic conditions and fear of job loss start to impact the consumer, the homeowner who needs to tap into equity, there is going to be a rush for the exit door. Hopefully not at the same time. But if it is, it only takes 10 to 15% of the market, which is distressed, to bring the market down by 30%. At least if you look at the history of the recent past for context. It could be worse, it could be better. I don't know, yet to be determined. Goes on to say that there's no return of 2008 or 3% mortgages. Well, I don't know what could happen from the Fed or from a policy perspective to bring back 3% mortgages. But if that happens, but it's no bueno long term, it will be great for the housing market. And then we'll see a bubble of epic proportions. But I don't see that happening anytime soon. And the fact is, the market is not being flooded with homes that drive down prices yet. And the banks are under no pressure because foreclosure rates are less than a tenth of what they were during the housing bust. And according to this article, households are not under financial strain either, with debt payment burdens near historic lows. Well, that might be true for now. If unemployment does what I think it's going to do, it will likely be true in the future. And for anybody who's getting a mortgage today with an adjustable rate mortgage, they are certainly setting up a dynamic in the future for that collapse. Because as I've said in the past, I suspect that mortgage interest rates are going significantly higher long term. The article goes on to say that housing affordability is stretched, and that is 100% true. Now, it will be very interesting to see what the most recent numbers yield, because January numbers will be reported on Tuesday, the 21st. So we're going to get a whole slew of more current information on a national level and on a local level very soon. And I will absolutely share it when it comes out. But for now, this is a backward looking article. This is information that is old. And it's easy to paint a picture with rose colored glasses on, looking back at what happened a month ago or a year ago. But for right now, at least here locally, prices are appreciating and demand has dropped significantly, while supply has continued to stack. The article goes on to say that the NAR's closely watched affordability index, which considers prices, rates, and buyers' incomes, is much lower than in 2019, but it's still in line with the late 1980s and early 1990s. That's interesting because inflation and prices have gone through the roof. At the current levels, the Housing Affordability Index says that the median buyer can afford the median U.S. home, but barely. Well, I can tell you that is 100% not true in my local market. Which then begs the question, why is anyone buying homes that are suddenly less affordable? And it talks about Maggie Neuter, a client of Fisher's in Chicago. The answer boiled down to wanting a new place and being able to afford one. Having already experienced 6% interest rates when she first bought her place in 2007, she's not exactly daunted by today's rates. The 41-year-old finance executive bought a bigger home that she needed during COVID to ride out quarantines, and now she wants a smaller place in the city's Lincoln Park neighborhood. And so what did she do? She did exactly what I've been talking about as the housing market dynamics have shifted. To make the deal happen, she bought down the buyer's interest rate fears. She's giving a closing credit big enough to buy down the mortgage rate on the buyer's loan for the first 2 years by 2 percentage points in year one and 1 percentage point in year two, a move that many builders are using to sell new homes. And if the market has weakness like this, you can absolutely exploit that. And if you have a motivated seller who must sell, you have weakness and leverage to be able to negotiate that. That will be based on a case by case basis, on a market by market basis. And you must work with a professional who knows how to leverage that, or you're probably not going to get what you want. And we always want you to get what you want. So if there's ever any time that we can serve or support you at the highest level, then please reach out. Which brings me back to the question asked at the beginning of this section, which is why anybody would be buying homes that are suddenly less affordable. The truth is, people who have money will buy what they want when they want it. And they'll be savvy enough to be able to go out there and negotiate the best deal possible for themselves, their family, and for their financial bottom line. But most folks who have the means do not want to delay living today. They don't want to wait 3, 5, 10 years for what could happen in the future. They want to max out South Florida living to the fullest right now. And so while there is an affordability gap and lots of folks are squeezed out of the market, those who have the means to purchase a home are doing so right now in a big way. And then it goes on to talk about wage growth. Add in wage growth. Wages rose about 5% last year, which means it's not pacing with inflation. Now, that's not what they talk about in this article, but the truth is, chances are if your wages rose 5% and the cost of living rose 7%, well, you're feeling the pain of that inflation, which is not everybody, but it's a lot of folks. So there are a lot of folks out there who are priced out of the market that they're shopping in. And actually, I spoke too soon because they go on to talk about it a little bit in the next paragraph. The big thaw in the thesis that only minor price drops are coming is that so many large regional markets like Tampa remain out of line with local incomes, and many of them were in much better balance as recently as 2 years ago. It goes on to say that much of Florida and Texas and markets like Asheville, North Carolina, and Denver have had relatively affordable housing until 2020. But median homes, which is never the right number to be looking at, you want to be looking at average sales price. But median homes are now 20% to 30% too expensive for median local incomes. Again, I hate median, you want average, but nonetheless, the point is intact. If home values have skyrocketed by 30% and your wages have only grown by 6% and inflation is at 7+%, well, chances are you're not able to buy a home, at least not in these markets. And then it goes on to talk about the 10 least affordable US metros in Q3 of 2022. And the least affordable metro is Los Angeles, which should come as a surprise to no one. But what is interesting is number 8 on the list is my local metro. We've got Miami, Fort Lauderdale, and West Palm ranking at number 8, coming in with a housing affordability index score of 53.9, with the median family income being 75,000, but the income needed to qualify for a purchase is 140,000. That's a big gap, and a lot of folks are priced out. And then the article goes on to talk about mortgage rates, which remain volatile. After falling for 5 weeks, the average contract interest rate for a 30-year fixed mortgage increased to 6.4% from 6.18% last week. To put that in perspective, it was 4.05% a year ago. But then it asks the question, how could affordability get better? And the answer, according to Olson, is that if rates come down to 5%, it gets radically better fast. Well, if that's the game we're playing, why not put it back to 2%? Because it gets a heck of a lot better fast. But 2 or 3% is not coming anytime soon. So if that's what you're holding out for, I hope you're not holding your breath. And then the article goes on to finish by saying the market standstill is likely to last for months because the main underpinnings aren't going anywhere anytime soon. Now, before I conclude, let's address the original question which was asked, which is how to know when the housing market bottom is in. And while I'm not a market timer and I can never predict the absolute bottom or the absolute top, I suspect we'll be getting close to the bottom when we start to see distressed sales stack. As of right now, as of today, there is nothing even remotely close like a significant uptick in distressed sales. And so, if that's what you're waiting for, I suspect you're going to be sitting on the sideline for quite some time. And by the time you are ready to capitalize on that deal, chances are interest rates are going to be significantly higher. And so, for most folks who are looking to max out South Florida living to the fullest right now, who are looking to live their best life right now, they're taking advantage of the weakness in the market right now. And those who are looking to time the market will wait. If these are institutions or investors or hedge funds or whatever it might be, I know there's a ton of cash sitting on the sidelines waiting to deploy into that market when it presents itself. But for most folks who want to be in a home yesterday, they're taking advantage of the opportunity that exists today. Because whenever that crash comes, chances are interest rates are going to be significantly higher. And I suspect the big money that's sitting on the sideline is likely to have the first crack at that distressed inventory. Now, I hope you found this content valuable. And if you did, please subscribe to the channel, give it a thumbs up, share it with a friend, leave a comment down below if you've got any, and check out my next video because I suspect you will love it a lot. And until next time,